Hello and welcome to the latest Insider interview. Our guest today is Talib Sheikh, a multi-asset portfolio manager at Fidelity International. Talib, thanks very much for coming in.
It's great to be here.
Today's economy offers up lots of challenges for investors. We've had an inflationary spike, we've had rising interest rates, now interest rates have begun to fall. So just how difficult is it to invest in this environment when you want to generate income?
I always say that a fund manager's job, when a fund manager says it's more uncertain today than it's ever been, I always push back on that. I always say it's always uncertain. We never know what the future is. And our process really is built around probing into that macro uncertainty, trying to find out what the next phases of the economy are likely to be and how do we position our clients' capital ahead of that. So at the moment, we would expect that interest rates are likely to fall over the coming years. I don't expect them to go back to the zero interest rate environment that we saw post the great financial crisis. I also think that business cycles have become more desynchronized. So if we think back where we've been over the last year or so, the Chinese economy's been terrible, the US economy has done quite well, the European and UK economy have been quite lackluster, and that creates opportunities for an asset allocator such as myself actually to move my clients' capital around to try and capitalize on places where we think there's value and it's getting better, and away from places where we think there's more of a headwind.
So you take quite an active stance to fund management, is that fair to say?
Yeah, my job is twofold. One is to think about asset allocation. How do we move the assets under our guardianship around? And we think about that in two ways. The first is a kind of structural framework. Where do we want to be on a kind of 6 to 12 month type view? What type of assets do we want to be holding? The next one is to be a bit more active on what we call a cyclical view. And that typically is a kind of 3 to 9 month view. And we want to blend those around to make sure that we remain a kind of medium risk portfolio. Typically we'll be under half the risk of the equity market. So not a zero risk portfolio, but certainly that medium risk is where we want to be, blending those assets together to give a decent, repeatable level of yield.
You mentioned that interest rates are falling and expected to fall further. How does this impact asset prices and where are you investing to profit?
It really takes us to government debt. Clearly, government debt has gone from being very, very expensive to arguably being fair value, maybe slightly cheap. And so I think that you need to be quite specific about how much interest rate risk you're taking within your portfolio. So we, at the moment, quite favour bonds which have a maturity of somewhere around 5 years, maybe out to 10 years. We're much more nervous about very, very long dated bonds. So when you're lending money to either the UK government or the US government for 20 or 30 years, we think that that's quite risky and unlikely to be compensated. Shorter term, 5 to 10 years, we are actually finding some interesting opportunities.
And where are those opportunities and what do you think about the gilt market today?
So we're relatively constructive on European government debt. We're seeing inflation falling quite aggressively. The ECB, they were the first central bank to cut. When I look across into the UK, obviously we've just recently had an interest rate cut, and we do think that that is likely to continue. I guess the UK has slowing inflation, but it always has a kind of persistent stickiness of inflation compared certainly to Europe. So we think that the capacity for the Bank of England to outcut the ECB is quite limited, and so we tend to be overweight Europe rather than the UK, but we do still think there's opportunities within the UK.
And what about the politics in the UK at the moment and this growing government debt? Is that a risk to UK bond markets?
I think so. I mean, we all know about the Liz Truss volatility from the inflation, from the budget. Obviously, we can't predict that we will return to that type of thing. I think the moment is that we're seeing government deficits across the globe really move higher. And certainly as we look into 25 and 26, governments really are going to have to get a hold of that, either by some kind of austerity, cutting the amount of spending, or increasing taxes, and certainly that's something which we are analysing and thinking through. But certainly when we look at the UK, so far it looks credible. You've certainly seen the UK's credibility in global markets actually be enhanced, and the gilt markets behave pretty well.
There's a lot going on in the economy today. We've had inflation spiking and interest rates coming up and now falling. Just how difficult is it to be a multi-asset investor today?
As I said earlier, we do think we're in a higher inflation regime. I think you have to break inflation into two parts. One part of inflation is what we call goods inflation. So things which are imported, things which are manufactured. And clearly we saw a huge spike in that post the COVID opening. So really those supply chains were disrupted. You couldn't buy second-hand cars, you couldn't buy new cars. Huge spike in that inflation. And to some degree that has normalized. And to some degree that's been the thing that's driven headline inflation lower. The flip side of that is what we call service inflation. So how much people pay for goods and services, much harder to trade across economies, much harder to trade across borders, and that has been falling but remains persistently quite sticky. So when you look at the Bank of England or you look at the Federal Reserve in the US, it's that services inflation that they're worried about, and that's much harder, that's much less interest rate sensitive. And so people talk about the last mile being the hardest. That's the area that we're focusing on. But we do think inflation is on the way down. We do think that this creates opportunities for central banks, not only in the UK, but also in the US, to lower interest rates from here.
And we've had this political change in the UK. The Labour government is now in charge. What does that mean for UK investors and UK assets?
So we've certainly seen UK assets really be out of favour from global investors for a prolonged period of time. And again, I think you have to split the UK into two parts. One part is the FTSE, which tends to be relatively international, tends to earn relatively large proportion of its earnings in US dollars. Compare that to small caps within the UK or mid caps or much more domestic stocks. And certainly there is value there. We have some exposure, but I think that's an area where we could see opportunities, and that also is an area that as global investors feel that the UK is growing, feel that the Bank of England is cutting interest rates, and feel that they can get comfortable with the new government's economic policy, that may be an area which offers some opportunity.
Capital growth is also important for investors, even within income portfolios. So where are the best opportunities to complement the income if you're seeking growth?
Yeah, I really think running a multi-asset income fund, we have three objectives. The first one is to provide a repeatable level of income. The second one is to try and provide some capital growth. That's really why we hold equities. That's why we hold growing alternatives. And the third objective is to make sure that we remain well balanced in that medium risk part of the portfolio. And why do I think that that growth is important? It goes back to that inflation idea. If we can have assets which can grow through time as well as give income, then we can provide a repeatable level of income to our client, and if we can give them some capital growth on top of that over the medium to long term, then I think we will have achieved on our objectives.
You invest globally, you look at all asset classes. Is there an area that you think is an under the radar opportunity that people at home or other investors haven't noticed at the moment?
I think some of the specialised areas in credit are really interesting. So again, when I look at the portfolios, one of our largest positions is in corporate hybrids. So what are these? These are bonds which sit somewhere between a pure bond and an equity. They're typically associated with European banks. People may have heard of them. Typically they're called CoCos. And they're something which you have to do incredibly diligent bond by bond analysis, which obviously our analyst team do. But they offer something which we think is quite attractive, and certainly they're a core part of our portfolio. I do think that the traditional equity income orientated stocks which sit out there have been underappreciated by global investors. I do think that there's been this run into technology which to some degree has got stretched, but I think it's meant that many of those more traditional, more boring stocks actually have been left behind and create opportunities for investors who are prepared to look a little bit below the surface.
Running an income fund, your biggest competition is probably a money market fund or a short-term gilt or even just a bank account. Yep. So why should investors use your portfolio for income rather than something a bit more secure?
I think it goes back to that idea about having three objectives. We absolutely want to have an income objective, and the income that we're delivering to our clients is higher than cash deposits, it's higher than government debt, it's higher than available in short-dated credit. We want to also try and provide some capital return. Again, it tries to protect our clients' investment from the ravages of inflation. And also it's important, as really many retirees live longer, their capital pool has to sustain them for 20 or 30 years. So again, if we can blend in equities at the right time to try and give some capital growth, then we do something which is very, very different from cash on deposit. But finally, we know that many of our investors are relatively risk averse. We know that we're running a fund which must have a higher risk than cash deposits, but we want to make sure that we remain in that medium risk. And if we can try and balance those three objectives, then I think we do something which is very different from on deposit, or very different from holding it in a short dated gilt.
And finally, the question we ask all of our guests: do you personally invest in your funds?
I do invest in my funds, and also we get paid in units of our portfolios. So our interests are definitely aligned along with our investors.
Talib, thanks very much for coming in.
Great, thank you.
And that's all we've got time for today. You can check out more insider interviews on our YouTube channel, where you can like, comment, and subscribe. See you next time.